And top traders never try to predict the market. They manage the risk. A popular saying in Wall Street is take care of the downside and the upside will take care of itself.
If you're in this stock and let's say you were in at 195 that month and the price drops by $20–30, what would you have done if you follow the traditional way of what people are told to do? You have a stop loss, 5%, 10%, etc. You'd be out of the market. Yeah, you would have taken that loss, right? And that loss you'd have to make up again to get back to even. Now, if you look at this stock, it's gone all the way from 75.80 to 200, back down to 120, then back up to 195 in about 3 months. Yes, if you are trying to time that market, that is so hard to do. Because what happens when a stock drops, you hit your stop loss and you're out of the market. Market goes up again, you think I want to get back in because I'm going to make my money again, you get back in at a higher price and then it drops again. That's how hard timing the market is. And if you were in this stock with the protected trader system, you would know that the maximum risk to the downside is 4 or 5%, and you can afford to ride these prices up and down out and actually make money with it. Today, Apple just was cutting $200 when we left, trading at $200 today.
One of the other things is everyone tells you to put 5% stop loss, right? Because that's okay, yeah, you can get out with 5%. You know, you've only lost 5%. What do you think the average stock moves? And I'm not talking about Apple, I'm talking about the average stock moves in a month, up or down?
Around 10.
About 12%. So why do you think that firstly, who started teaching about investing in the stock market? It was the brokerage houses. Okay, they were the first ones to start teaching about investing in the stock market. And they're the first ones that also implemented this 5% stop loss rule. Why do that? Where do brokers make money?
By trades.
Commissions. Commissions on the amount of trades that you do. So it's in their benefit for you to get out, get in, get out, get in, get out, get in on a month, you know, as many times in a month as possible. And that's why the 5% stop loss has become very, very popular, because it makes the most money. Now, this is RIM. This is the makers of BlackBerry. This is when the iPhone was announced, as you can see. $60 drop in a month. The question is, can you handle that? Okay, can you handle that in your stock? Can you? Would you have the emotional strength to sit through that and then continue holding RIM? Most people would have got out. Most people, and they did. Okay, RIM went from $140 to $40 in 3 months. Yeah. When Apple announced the iPhone. No, I'm only joking, that's not when Apple announced the iPhone. Long-term investing, this is the Dow Jones, over 70 years, you will make money every single time. Over the long term, 70 years, 10% plus annual long term. It's about 11.24%. You will make money in the long term. Where people lose money is in these short-term dips. Now, what is the other rule about investing? Diversify. Yeah? Diversify. Who do you think is the most successful investor in the world?
Warren Buffett.
Warren Buffett. Yeah. What is one of his rules?
Don't diversify.
I don't diversify. So, it amazes me when people listen to traders that will screw up the economy, like we've experienced, but they don't listen to the most successful investor in the world. Okay? Where in this period, in 2008, this is over the whole of the world, where would you have made money? Nowhere. So where would a diversification help you? Okay, so you need to consider that. This is what you call a performance chart for all the markets. And in 2008, every one of these markets was down. If you had diversified even equally across, you still would have lost money. Does that make sense? And that's a key thing to understand. Diversification doesn't help in the most drastic of markets. Now, a stock is an income-generating asset, just like rental property. Who owns investment properties or parents own investment properties? Yeah. Okay. So, property is an income-generating asset. That's what most people get into property for. A stock is an income-generating asset too, but most people don't know the income-generating potential in a stock. Okay, and there's far more potential than you think. It's like, who would own a property and not rent it out? Yeah, nobody, because you've got to rent it out. That's how you generate the cash flow. Well, if you own the right stocks and limit the downside, you can get paid to own that stock because you can rent the stock out on a monthly basis. Now, the yields on properties, you're getting 6% per annum. The yields on stocks, you're looking at 3% a month. So you consider which yields are better, and when you can actually protect your investment in the stock market, then it turns out to be a much better investment proposal. Now, this is our alternative to the buy, hold and pray. We buy the stock, insure the risk. If it goes down, we're protected. We have got a limited risk on our asset, and we get paid on a monthly basis to own the stock. If it stays flat, we're protected, and again, we get paid. So we haven't got the opportunity cost if it stays flat, because we're getting a return on a monthly basis. And if it goes up, you've got unlimited profit, and you get paid. Okay? So this is the model that we follow. So why should you insure and rent stocks? Number one, because stocks drop very, very fast. Leverage, if you're using leverage and the stock's dropping, you can get called out on a margin call. And I've seen investors wipe out portfolios, millions of dollars worth of portfolios just by a margin call because they don't know how to manage the risk. And you get rent to generate an income and pay for your insurance. So why do retail investors make less money than institutional investors? This is the logical thing then. So if these strategies are out there, why do retail investors make less money? Number one, they don't insure the stocks. They do not understand the risk in a dropping stock. And they use the buy, hold and pray strategy. And they need to sell at the wrong time. Most people need to get out of the stock market when they've got university fees to pay. Yeah, when they've got a marriage to consider. And that's the worst time because your emotions are tied into the market. You get stopped out and then the stock goes up. Those guys have been investing in the stock market. Who's placed the stop loss? It hits the stop loss. You get out saying, yeah, I've only lost 5%, and then it shoots up again. Yeah? You know the feeling. Why? Because stop losses can be seen by the market makers. They can see the stop losses. So they know where the majority of the stop losses are. If you've got enough capital, what's the logical thing you'd do? You crash the stock, buy it, and watch it go up again. Let new Muppets come in, place new stop losses, and do the whole thing again. That's what Wall Street is. Retail investors have limited capital, and they have a short-term mindset. And it's this day trading encouraged by brokers. Who's at a Schwab broker? Yeah, Charles Schwab. They generated 232,000 trades per day. And each trade was at a commission of between $9 and $30 each trade. So you can see where a lot of their cash flow is coming from on a daily basis. Okay? And then chasing the trend, buying at the high, selling at the low. It's greed and fear. Popular one is, as soon as the stock makes it onto Time magazine's front cover, it's time to get out, right? That's the popular one that people pay attention to. So this is the cash for life trading plan. Wall Street insiders use stocks and options to protect their capital. Who's heard of options investing? Okay, cool. Stocks, they use options to protect their capital and to make money every month, no matter what the market is doing. Who likes the sound of that? No matter what the market is doing. It doesn't matter because you're not responding to the market, you're being proactive. The benefit of being proactive is that you haven't got your emotions involved. Okay? You buy the stocks in large, solid companies. It's not, IPOs, etc., 1 penny shares, none of that. Solid company. You buy the